Today's market call is presented by FactSet, financial data and analytics powered by tomorrow. A very good afternoon, folks. Swizz here, Dan Nathan there, soon to be joined by the great Carter Worth. It's June 4th. It's 1 o'clock on the East Coast. How are you, Dan?
I'm doing okay here, Guy. You have a little breather in between, the Stanley Cup final. I'm sure you'll be watching that. There's a guy on the Edmonton.
I will be. Absolutely.
You're just excited about. Yankees playing great baseball. Nice little test coming into town this weekend with the LA Dodgers. I don't know how you're feeling about. I know how you feel about the interleague play. You're not too excited about it, but again, it's just going to be something that's here to stay, isn't it?
Well, that's old man yells at cloud. Is that a thing,
Yeah.
right? I mean, Bill Hockman gets a kick out of me in terms of when I go on these. I won't do it, but yes, I mean, in a number of different ways, they've ruined baseball. Interleague play is one. There was a time when the only time you saw players from the San Francisco Giants or the Montreal Expos back in the day, or even, let's say, the San Diego Padres was at the All-Star game, and you were like, wow, those are really cool uniforms. And now they've thrown everything into the hat, and everybody plays everybody, and they effed it up. But, whatever.
I got you, dog.
And then you throw on top of that, I'm sorry, Amanda, now they go into London to play baseball? Are you shitting me?
Well, the Brits deserve a little baseball.
Why? I'm just curious. I mean, I don't understand.
Before we get into the rundown and bring Carter in, I wanted to talk a little bit just about what we're seeing in the broad market. We're not going to do the charts in the S&P and the NASDAQ and everything like that. But from a sentiment standpoint, it feels like a lot of the good news in generative AI, a lot of the good news in GLP-1s, is kind of in the stock market right now. We've talked about some of the FactSet data, our main man, John Butters, has been putting out about the performance of the major indices. And obviously, 5 names, a disproportionate amount, the year-to-date gains and of the S&P at 10.5%. What's your, just a little bit of a vibe check here, Guy? Because I think you and I were feeling sort of similar trepidation as we headed into the summer months last year. And we were talking about some of the same themes, generative AI. And we're like, listen, they're crowded trades. And unless we could start seeing the goods, you know what I mean? The market seems vulnerable from a valuation standpoint, from a sentiment standpoint.
Well, the vibe check suggests that people are breathing a collective sigh of relief in terms of we got through earnings seasons. We've seemingly getting through some of this geopolitical stuff. They're getting a break in terms of crude oil prices, which we'll talk about. So everything is seemingly coming up roses. But then we had a conversation yesterday about people looking to buy put protection in the form of a 10% pull back is on the rise. So there's so many cross currents here, but I think really what it comes down to is people we've made it to the summer. Typically, things don't really happen during the summer. Things get quiet. You never saw a dull market, those types of things. And I think there is this collective sigh of relief going on.
Yeah. All right. Let's put up the rundown here, Guy. Christopher Adami here. We're gonna hit yields, and you and I pushed back last week on Carter
incorrectly. Carter was spot on.
He was spot on, and he was steadfast. We're going to take a look at, you just mentioned crude oil, but we're going to look at the energy stocks. They've really taken on the chin over the last few trading sessions. And then CrowdStrike. This is an interesting space. I would say this is kind of AI adjacent. These are the cybersecurity stocks, but some of the competitors that have reported over the last couple of weeks have not been particularly great. And the stock price of those two, have been under pressure a little bit. So again, let's just throw up our yield chart for a second here, Guy. This is the 10-year yield. And I just thought this was interesting here. We're kind of at a level. Carter will walk us through this. What do you think the main takeaway is? Because we were talking about it, I think, on Fast Money last night. Is okay, so yields are gone from 4.35 up to 4.65, back to 4.35. I would have expected over the last couple trading days, home builders should have been acting a little better. Some of the banks, we mentioned this yesterday, should have been acting a little better. The XLU utilities has been down, the last. So what do you think's going on here with lower yields and some of those sectors that you would expect to act better?
Growth concerns. I think it comes down to, again, why are yields going down? And they're going down for the right reasons or the wrong. And again, I don't know if there are right or wrong, but to answer your question specifically, I think the precipitous drop in yields, and think about it, it took probably 3 times as long to get from 435 up to 465 as the round trip is taken to get back down. So I think it really comes down to the market is saying, wait a second, there are some growth concerns out there. And we're seeing in some of the manufacturing data, we're seeing in some of the GDP data. I mean, on the edges, things seemingly are slowing down. And I think that's one of the reasons why sectors which should be doing well with yields going lower are probably running into some headwinds, because I think there's some growth concerns out there.
Yeah, and so when you talk about growth concerns, are you more focused on the consumer? Are you focused on, and does that just flow through to enterprise? Our friend Doug Cass over there at Seabreeze, who writes for Real Money, had a really great note this morning. And he was just kind of summarizing what he thinks is a consumer that's getting pretty strained and about to roll over. And is that the first place that you would look for in weakness? And we've been talking about Starbucks and McDonald's and Kohl's and Dollar Tree or Jen or one of the, you know what I mean? We've been talking about the trade down in Walmart. We saw some difficult results out of Target. Is that where you'd most focus here if you're really focused on growth right now or the potential for it to slow down?
You have to. I mean, I believe, listen, at least the way I look at things in terms of the United States, you absolutely have to, because so much of this economy is driven by exactly that, the health of the consumer, or the perceived health of the consumer, and their ability to spend. And, we've talked about the numbers. Nobody seems to care, but overall consumer debt now is approaching $18 trillion. I mean, there are a lot of things out there to be concerned about. And by the way, this has been happening on the right side of the unemployment rate, right below 4%. God forbid that ever starts to tick up in a meaningful way. And all those things, I think, are just going to be more magnified in terms of the market focusing on things. So as much as people, I think, believe that a higher unemployment rate is going to be market positive, I'm not so sure. So when you start seeing the market concerned, and this is through the lens of yields, obviously, market's concerned about growth, I think it all starts and ends with the consumer.
Yeah, no, I agree. Check out Doug's work. It was really good. A lot of bullets and a lot of charts about what he's seeing and kind of threading the needle a little bit on that front. All right, let's bring him in, guy. Carter Braxton Worth
Love
of
him.
Worth. Love him. There he is, all knotted up.
What's up, guys? Yeah, God, what a strange day, or every day strange, right? Rates down, market down, dollar down, oil down. It's all a little bit sloppy.
Yeah,
it is. Yeah. No, sorry, Dan, but I was going
to
say.
I was just going to say, guy, last week you and I mean, we're getting all up in Carter's grill a little bit, right? And he was giving us the thing. As soon as, everybody starts saying, higher for longer, this and that or whatever, he wants to look the other way. So, guy, what were some of the things that, like, you've been talking about auctions, you've been talking, like, what's the bull case right now for yields again at 435? And remind us why a few weeks ago we went from 435 to 465.
Okay, so when you say bull case, I'm assuming you mean yields going higher. So
Correct.
Bear case for bonds, bull case for yields. And, I think you just addressed it in terms of the treasury auctions that have been taking place. Number one, the last few auctions we've seen haven't been particularly good. And until obviously the last week or so, we saw yields rise on the back of that. I think what's going on in Japan, although seemingly mitigated over the last couple trading sessions, is also a concern. Obviously, some of the things going on in China is also a concern. The flip side of that equation, why yields can go lower, is growth concerns. And, maybe the fact that the economy is moving in a way that the market doesn't fully comprehend in terms of the slowdown, and yields should be lower. So you have this push me, pull you effect. Obviously, I think there's a hope that the Fed will cut rates, which for whatever reason, people will think will take the 10-year down. I'm not one of those people, by the way. I think they have far more impact on the short end of the curve, but that's right now the dynamic. And I think that's why you're seeing the continued volatility in the 10-year when you go from 435 to 465 and round trip the thing over the course of a month and a half.
Yeah, Carter, you think we're obviously overthinking it on the macro and the funny mental.
I mean, look, I obviously you have the burden or the privilege of doing that. I get to just say, hey, I'm not in the why business, I'm in the what business. But, I suppose the bull case for yields is a mismatch between supply and demand, right? And that basically the four big buyers for the past many years have been insensitive to price: the U.S. government, Japanese, the Chinese, and big U.S. banks. And that's probably not the case. Maybe I have something that a client had, I get replies to things I publish, of course, and some people, say, but here one person, he was saying that he thinks it's much higher rates, and This is a firm they're running about 350 billion. This particular portfolio manager, maybe only 4 or 5, is mid cap. But he was saying, let me see if I can find it. The U.S. government is about 40% bigger than the day before COVID, right? According to the president's budget, the size of the government expenditures will be larger than ever in history. In my recollection, history, we can set tax rates wherever we want. And the American people will allow about 19% of GDP. After that, they don't allow it, right? They vote you out. He's something about government spending at 20. They're begging the bond vigilantes to wake up from their slumber. I think the policymakers should not be asking for the fight. They should be establishing some sort of fiscal anchor, some description of what's going to happen. And he goes on to say, and I'll just finish it here. He said, what are we doing instead? We're begging the world for money at a time we shouldn't need it for a size of government we've never had, many of which expenditures are not at all obvious that we need. Anyway, I mean, he's in the nightmare scenario. He thinks it's going to be, supply and demand mismatch. You're talking about 7, 8, 9% as you stall into a recession. And well, if that's happening, you're talking about, 50, 60, 70% down the S&P for sure.
And by the way, Dan, I mean, I wouldn't say the severity of those comments, but in principle, I agree with everything that gentleman or lady is saying, number one. And by the way, this, Dan, echoes a lot of the things that Jamie Dimon's been saying for quite some time. And he has similar concerns. Now, those concerns are not manifesting themselves in terms of the bond market over the last couple of weeks, but those concerns have not gone away.
Yeah. Carter, did you see my chart? You like my lines? I mean, I always love a great.
Put that back up there.
Let's throw it out.
I mean, look, it's breaking this minor trend, but again, it's only a few touch points. I mean, here and now, I guess this might just be, and this is the thing, that it isn't higher or lower. That all of us are fascinated, fixated, some people more than others, on the cost of 10-year money, and it's benign, right? It's not 7, 8, 9%, nor is it 2 or 3, and that this is some sort of perfect place for it to be, and that one, as a securities analyst, can go about their business of trying to figure out 3 to 5 year cash flow, discount it, and come up with price targets for individual companies and so forth. But my hunch again is that the higher for longer thing is just not accurate. But I think we got some charts. I don't know.
But hey, Carter, and I just want to make one point. You've been making this point on Fast Money, on Market Call for a very long time. And Guy, it's kind of interesting. It's like going back to when Rick Santelli was on Fast Money. And again, I'm not giving him a hard time. And he wasn't calling a point in time, but it was back when the 10-year yield was at 5%. He's like, get ready in the coming years to see 10%, maybe 12% or something like that. Okay. And then you know what happened? We went straight to 3.85 or something like that. And then we've seen calls for people saying that, they're going to go down to 1% because we're going to have a calamity or this and that. Whatever. Carter, the whole time you've been telling us for the last 2 years, sideways. And that doesn't sell, I guess. You know what I mean? Not on TV or clicks or anything.
Yeah, it's not a very, it's sort of a boring, no one wants to talk about it. And I get that. I think the key, and it's annotated there, that 435, that's the low for the stock market, right, in October of 2022. At that point, if you think about it, on a 6-month basis, rates had basically go from 1.75 to 4.5. And when that happens, stocks don't like it, right? So the S&P drops 27%, the QQQ is up 37, and that's when it started really gripping people. We'll extrapolate this one more go, and we're going to be at 6-7%, in which case there's a problem. And then the higher for longer not only becomes popular, it becomes a mantra. But since that moment, here we are 20 months later, it's almost 2 years later, and the cost of 10-year money is the same. Stocks are much higher for that reason, because we didn't go to 6 and 7%, and it really hasn't been higher for longer. But let's run through some charts. This is one way to draw the lines. Look at another. We can flip through here one at a time. There's the thing. Let's toggle between the first two. The truth is that we're not higher. We're not. Now one could say yes, but that's convenient because we did go to 5. Listen, 5.01 or 02 is not higher either. It really had to be 6.5, 7. Now, next chart. Who's to say that my arrow is right? Again, that's a judgment. But after all of this, all of the commodity moves and all of the tightening and all of the housing and the rent spikes, it's just not higher. It would take the bond vigilantes, and it would take some real backing away on the big buyers, the Japanese, the Chinese, the U.S. government itself, and of course, big U.S. banks. Let's keep going. We got some other, flash that. I mean, that's Does it have to break here? That's cutting you on the line you have, Dan, on your chart. It's starting to break that just now. And then maybe we have one more. I don't know, but that's my guess. There might be one more after this, in fact. So I'm in the lower rates camp, but it might just be that all of that is nonsense and rates are just stuck.
So let's talk about the ramifications of that. I think people hearing that are going to say that's great news. Lower rates means higher stock market, and maybe it is that simple. I have no idea, but is that sort of the camp you're in? If we in fact start to break down in a meaningful way, that's going to be supported.
Yeah, my hunch is we've already had the benefit of all that. And then if we were to break down, and Guy, you and I and Dan have talked about this obviously together and in this forum, that rates lower is good until it's not good, right? And that if we do, we're a long way from getting to 4 here or high 3s, but you start to do that, I have to believe that would be something that speaks to the opposite of what we have now, which is an ongoing economic expansion.
Yeah, Carter, if you do break right here, looking at this chart, I mean, you can see the formation. If we get back towards 3.5 or something like that, which again is where we got down to, or just above that, after we got to 5% in the fall of last year, it looks like a fairly epic, kind of head and shoulders top with a neckline around 3.5. And so Guy just mentioned the knock-on effects, so in the stock market, but right now we're seeing this, and we kind of highlighted this. We're surprised that, some money center banks, the XHB, the home builders are not acting better today. Also the XLU, but one sector, and Guy, it got my attention because Guy's been on this T-Mobile train for a very long time, and the outperformance in T-Mobile relative to AT&T and Verizon has just been staggering. You wanted to focus today on Verizon. We obviously know the yields on AT&T and Verizon. They look more attractive as yields go lower. Give us your take on, and is Verizon to you the best opportunity of these three after we've already had the T-Mobile breakout?
Yeah, T-Mobile is a strong stock that's getting stronger, and I like it. This is a weak stock that's trying to play catch up. I mean, one thing I remember in the AT&T is the same thing, but right now Verizon has the same net income, literally total dollars received, as Walmart, but its market cap is 175. Walmart's probably 550. A decade ago, and I remember this too, the second most profitable company in the world was AT&T after Apple. And the most indebted company in the world is AT&T. That still is the case. Toyota might have a little bit more, but they're bonds, right? That's what this is. They generate a massive amount of net income, but they do it as a highly indebted. And so if and as rates are going to go lower, the presumption is that something like this is a place to be. But let's put in the lines. You have a downtrend line, and I've got an arrow there, just returning to the 45 level. That's nothing from here. We're 41. Let's keep going. Another way to draw the lines. There's yet another way to draw the lines. We can keep going. And so I'm a buyer. The day-to-day relative strength is good. And what is this exciting stuff? No, but it's got, I don't know what the current yield is. It's probably 6 to 7%. There are these things out there like Philip Morris, right, and AT&T, and it is a bond, and it's going to pay its dividend, right? They do whatever they have to.
Look, we could throw our own AT&T and Verizon charts up. Obviously, the underperformance vis-a-vis the broader market and specifically T-Mobile has been unbelievable. But however, as Carter points out, there have been times along the timeline that, these stocks have rallied, and we're probably, setting up for that. So we'll see. But, the thing that, again, you've gotten spot on, a lot of things, but crude oil has been one of them. We have our own little basically slide we want to put up before your charts, but there's obviously a lot going on. The news flow recently has been obviously pretty dramatic in terms of its effect on the underlying commodity. There's our stuff. That's from CNBC. So let's get into your charts because, just as when you say the euphoria is out there as a time to get out of these things, well, this is as much negativity around the underlying commodity and maybe some of the stocks that I've seen in a while, Carter.
Yeah, at the sort of 77, 76 was looking for a bounce, and it's gotten worse. But structurally, I think there's a lot of, well, here too, not hysteria, but it's just all you do is move something down $2-3 of yesterday barrel, and all of a sudden, oh my gosh. But look at this chart. This is getting down to the 2020 autumn lows, not the COVID lows, because oil literally went to almost zero for a brief rip there. But look at these lines. Let's demonstrate to the penny. Look at the circles. mean, let's flash those circles for fun. I mean, that's not random. I mean, this is an annoyance to, again, Saudi Aramco, to seismologists and geologists. Exxon doesn't like it, but it's very real. There's no way around it. And it touches those lines to the penny. Buy, sell, or hold here. I think you buy for a bounce. Oil has just dropped from 87, 88 a barrel to 72 a barrel. Buy, sell, or hold. Do nothing. That's fair, but I think you buy.
Well, the relative charts that you bring are always interesting. And so here's the underlying commodity. But when you do sort of energy vis-a-vis the SPX, I mean, this is where it gets really interesting, I think.
Yeah, I mean, this is fun stuff, right? So this is a relative strength, a relative performance line, energy's relative performance, the sector to the overall market. It just looks like nothing, but if you put some lines in, you'll see that it's very precise. Again, look at let's put some arrows in. I mean, that too. This is the kind of thing that a simple chartist can see optically, but really, what's behind it is probably a lot of ones and zeros by Jim Simons. God bless him, he's moved on. But a lot of big quant people. I think you play for the bouncer. So this is now one could say, but that's very short term. That picks up the COVID low. Take this back. Now here is again. So you see that energy stocks are massive outperformers in 2007 and 2008, right? Lehman Brothers going down, Bears going down. And energy stocks are selling off hard, Chevron, Exxon, but their relative performance is straight up because they're selling off less. So let's annotate this. Let's put some arrows in. Now, again, one could say, I cannot accept this. I was number one, summa cum laude in my high school. Then I was at Harvard. Then I was at Harvard Business School. Then I studied seismology and geology. I'm an expert, industry expert. Screw this chart. I don't like it. I don't want to see a ratio chart of Exxon and Chevron and Conoco and Hess and Marathon and Valero and PSX to the S&P. But man, look at those lines. Do you play for the green arrow? That's my bet. Does it have to happen? Of course not. I'm making the bet you buy energy here.
All right, Carter, what's your time horizon and what would your target be? Like what percent of a move? And I know you're a measured move sort of guy.
Yeah, hard to know. But I would, maybe this is introducing a little bit of fundamentals, but energy is about 3.7% weight, right, in the S&P. Utility is exactly the same, materials and REITs. Look at that. Now, You know what the funny thing about those bottom four, that they're all about the same? Do you know that the net income of that one that's in green is double utilities, double the materials, and like quadruple the? It's always cheap, one could say. But if one's thinking that we're heading into maybe a little bit of market trouble, energy has a defensive characteristic, most notably those two big fellas, Exxon and Chevron, that will serve one well, not to mention decent yield.
Yeah. One thing, and the reason why I asked kind of time horizon and target here a little bit is like, I was just looking at the options in USO. So that's a US oil fund. It's an ETF, or it might be an ETN, but same difference, that tracks the price of oil. And again, it's trading at 71.40 or so. I was looking at like the 72 calls, about $2.50, about basically 3.5% of the underlying, right? And maybe you want to kind of turn that into, you could sell the 79 call, maybe you get 50 cents for that, right? So you could do the 72.79, that's $7 wide. That's about 10% or so of this ETF. You would have until July expiration. Your break even's at 74. You make $5 between 74 and 79. I'm just kind of throwing that out there. That gets you back above that moving average there, and maybe back towards that level, where we were kind of saw some resistance in that consolidation over the last few weeks ago. Thoughts on that range?
I like that. And also you'll see that there's while this is the liquid, so you can't say it's gappy, but XLE had a gap today. It feels this has come down a long way, right? It's not a day or two. It's now a full month of selling. My hunch is that it's just getting a little panicky, and that what you've articulated is exactly the right thing.
Guy, do you have a preference? XLE, so large integrated oil. We know that Chevron, Exxon, and there's one other that make up, 50
ConocoPhillips,
or OIH. Maybe they can pull up that, so the oil drillers, because that thing has gotten drilled.
Yeah, it has. I mean, the XLE, it's funny. With the XLE, if you do a longer term chart, you'll see that we traded up to this 98.5, 99 level. If you go longer term, you'll see exactly what we traded. You got to go longer than that, and you'll see we stalled exactly to a prior high, which is somewhat concerning in terms of the XLE. I still think there's room to the upside. We're right back to the moving average, so there's a lot to sort of like here, but those double tops, obviously, Dan, are reason to be, to understand what's going on here and to be somewhat cautious moving forward.
Carter, do you have a preference? And listen, I'm like visually drawing a line from that double bottom, you know what I mean, about a year ago. I see a pretty well-defined uptrend, right?
Yeah. I mean, look, you're going to get there's a high correlation, right, between, what is it? OIH is probably Schlumberger, Weatherford, Halliburton, Baker Hughes.
Those three. Yep.
But in many ways, if you're feeling defensive, though, or feeling that the Exxon thing alone will be safe, right, versus the more cyclical Schlumberger and so forth. But either way, if oil has come down to such an extent and such a level where it's overdone and due for a bounce, and that's the case for energy shares as well, either one will get you done. Guy, your expression often last call. What's that thing at the end of the
final call? Hey, listen, Carter.
Final call. Yeah. So that'll get you done, as Guy likes to say, like that. So there you go.
You can use our expressions anytime you want.
To get you done.
We rip you off. I think
it brings to mind other things, but hey.
Hey, so you're going to be on the CNBC's Fast Money with us tonight. Will you be in studio, or are you going to be from your office?
I'm going to be here.
Really appreciate you being here.
All right, man.
Today. All right, see you, brother.
Yeah, bye.
Guy,
love him.
Interesting stuff. So, just all in all, you heard what he had to say about crude. You heard XLE, OAH, and you obviously started out that conversation where you're inclined to kind of pick at it. Do you agree with the defensive nature that he mentioned? And really, I think he highlighted that by just talking about the net income in that space versus the other names and how it eclipses it.
I think in order to be bullish as I am in energy, you have to look at a couple different things. Valuation is compelling without question. They're better run companies without question, but you need a sell-off in technology. You need a rotation out of tech into energy, which we've seen a couple times over the last year and a half or 2 years, but it hasn't lasted. So you're going to need a meaningful sell-off, I think, in the tech sector in order for the dollars to find their way here back to energy. And the fact that we stalled, and especially the XLE, at those prior all-time highs is concerning, but it's not a deal breaker yet.
Yeah. All right. So let's talk about that rotation out of tech. And really, I think we ran a chart yesterday, the SMH versus the IGV. We know it's been going on in software. It really feels like it's ready for kind of lower lows too, right? Maybe into kind of Q2 earnings in late July. Let's look at Taiwan Semi. We haven't really talked about this one in a while. We had this Computex in Taipei over the weekend. We know that there was a lot of excitement in and around what NVIDIA laid out for their 2026 platform. That would be Rubin, that comes after Blackwell, which is 2025. Obviously Taiwan Semi makes a lot of these chips. I think they make over 85% of high-end GPUs. We just drew those trend channels a little bit, Guy, just because they're there, and we see this kind of last few trading days below that channel, below that uptrend we saw last time that happened. Wasn't that deep of a pullback. If you could say, okay, well, maybe off that March 8th reversal, that was pretty significant, but we had that consolidation, then we had the breakdown. So if we were to see Taiwan Semi, maybe they can throw up an SMH really quickly here too. This really does kind of fall into the hands of NVIDIA and Taiwan Semi. Yesterday we looked at Intel can't get out of its own way. AMD had some supposedly great product announcements and roadmap and that sort of thing. The stock has barely seen an uptick since it gapped up yesterday morning. So is this the rotation that you would need to see? Because we already have other parts of the tech complex kind of at least kind of moderating their upward performance or in the process of selling off.
So that's the SMH trading around 240. I've thought, and it looked like I was a genius in April, and now obviously not so much, but I thought 163. And if you do a longer term SMH chart, you'll see sort of those levels that I'm looking at. These were two prior highs that we saw that were effectively double tops. And if you go back and just forget about what's happened since December, what we saw in the summer into the fall of last year suggested these double tops worked. Of course, we traded down to the moving average and bounce has been off to the races ever since. But I think that past resistance will in fact be support at some point, number one. Number two, throw up a non-static Taiwan Semi chart and you'll see again, 140-ish had been some prior double tops. So we obviously blew through. We're trading 152 or so now. I do think there's going to be a revisit of sort of this 140 level, and we'll see what happens if and when we get there. So look, there's a lot to like. There are unfilled gaps on the downside and a lot of these different things, Taiwan Semi being one of them. I think to fill the gap, you got to trade down to about 106 or so. we'll see what happens, and we'll see if it correlates with the rotation, and we'll see if it obviously correlates to a broader sell-off in the SMH.
All right, let's hit one name that's reporting tonight after the close. I'm sure we'll be talking about it a little bit on Fast Money as the results are coming out and the conference call is going on. This is CrowdStrike, and I think this is an interesting space because, again, I think a lot of folks think this is AI adjacent. There's like tons of this, generative AI technology that will be used to kind of, detect, cyber attacks and the like. And again, we've been hearing about this space for years and years. We've seen dramatic outperformance. We obviously saw from 2021 to 2022, these names get absolutely killed. A lot of that has to do with valuation, but the implied move in CrowdStrike, guys, about 11% in either direction. It's interesting. Over the last 3 quarters, the stock has moved on average about 10% to the upside. Now, one chart I just want to pull up. Let's go to the next one here. I drew an uptrend from, last, I want to say fall or so. And you see that support, then became resistance. Now we had that sell off, into the spring, like most tech stocks did. You had that move right back to that uptrend, right? That's now resistance. So thoughts on just the setup into this? It sold off with some of these other software names over the last week or so, but expectations were pretty high. It made a new closing high 2 weeks ago.
365 down to 307 over the course of a few different trading days. I mean, that's a pretty dramatic move. So I think a lot of people, the optimists, will say, well, the setup, given that move to the downside, is actually pretty good. And listen, maybe that's the case. We've also seen some dramatic misses in this space, Zscaler being one of them, Palo Alto. Now, with that said, each time, if you can sort of stomach those moves, those are provided with you an entry point. These names concern me on a lot of different reasons, and I love Palo Alto, as you know, but valuation being one of them. And Dell's an entirely different company. I get it, but even the slightest miss and or the slightest disappointment in guides, and you see pretty big moves to the downside. So I'd much rather be taking a look at this at the moving average, which I think is probably about, 265, 270, that basically here at 308.
Yeah, and again, there's still really good revenue growth here. CrowdStrike expected to grow sales this year 30%, 26% next year. Earnings growth is coming off on a GAAP basis, guy. They just hit GAAP profitability last year for the first year in its existence, and so off a low base, we're seeing high growth rates, right? But on a net income basis, it's not that dramatic here. But trading at about 78 times this year, 63 times next. I mean, all right, for a secular, fast growing, that sort of thing, like I get it. You know what I mean? We have gross margins at 78, 79%, which have been improving a little bit over the last few years. Look at this 5-year chart, though. If you were to draw a horizontal line from the prior high there, you see that we're, that would be support, right? If you were to get down there. Yep. That's just technicals, that sort of thing. I mean, I'm not poo-pooing them. I'm just saying, so we're very near a level that people were focused on as we were approaching it after it had that kind of parabolic move. So I don't really have a great feel for this, but let's pull up the Zscaler and the Palo Alto just to give people a sense of just how the outperformance in CrowdStrike versus Zscaler, and then about Palo Alto. And again, would you rather be picking at these names as they reached relative support after a couple bad prints, or would you be taking a shot on the CrowdStrike?
Palo Alto is the one. I mean, this is a static chart. If you do a longer term chart, you'll see, the problem with Palo Alto, obviously, it's volatile as hell. And, the moves are more dramatic seemingly to the downside, although we've had a couple of upside surprises as well. But to answer your question specifically, I'd rather be buying Palo Alto here at the moving average than CrowdStrike here, sort of in the middle, I think, what is no man's land.
All right. Well, listen, guy, we covered a lot of ground.
We did.
We got to hang out with Carter Braxton Worth of Worth Charting. Guy, we love that people tune in to the market call every Monday through Thursday at 1 p.m. A lot of people find it after we do it live. We do it live just because we do it live. We
got to do it live at some point.
Yeah, not everybody can get here, but the thing actually really grows, and we really appreciate it. If you can't watch the video, you can listen to it in the podcast stores. That's MRKT Call, and we have a really nice following there, so we appreciate that. But, guy, if you are doing other things, you're not staring at your FactSet machine all day and this and that, and you want to know what happened in the market, in that trading day, shortly after the close, the Risk Reversal Media team drops the market matrix. That's MRKT matrix in under 10 minutes. I think, and I think you think, you can get up to speed with what happened in the markets, what happened in the economy. This is an AI-generated podcast. Our team, Guy and me and the rest of our team, we curate the stories. We look at them all day long. We keep kind of positioning them, what we think are the most important things. And by the end of the day, we take those, we have Perplexity kind of summarize them. We take a look at it, then we pop it into an 11 Labs, which is a audio bot, and you get this awesome podcast. In under 10 minutes, you get up to speed. And here's the deal. Go follow it in the podcast stores, leave a review, rate the thing, take a screenshot of that, send that screenshot to contact@riskreversal.com. And you know what? Remember Amanda, you know, the one who's kind of in the chat and all that stuff? She's going to send you a t-shirt like that, pretty tricked out. So send her the size and you'll get those things. So rate, review, listen, follow, download, get a t-shirt, Guy.
Leave a 5-star review. I love that. Telling people what to do. Only Amanda can get away with that. And quite frankly, you should listen to her. So it is pretty cool. Anywhere from, again, you said 5 to 10 minutes, you're going to get, I think, all the things you need to know to be up to date in terms of what happened that day and maybe what's going to happen over the next few days. And Brunson, as you say, Dan, all the time, is a vibe.
He is a vibe. Listen, I ripped that off of an AT&T commercial with Jalen Brunson. Just so happens that our voice bot is also named Brunson. I don't know where that came from, but we're pretty excited about that. And a really funny bit at the end where he says to his wife, "I am a vibe."
All right. That's the basketball player Brunson, not our Brunson.
Not our Brunson. All right,
so we're clear.
That was a lot of fun. We did this thing.
Yankees play baseball tonight. I believe the Twins are in town, if I'm not mistaken. But as you said earlier, everybody's sort of waiting for this weekend where the Dodgers of Los Angeles are coming down for the first time in a while. That's always fun. This is always fun. Carter will be on Fast Money tonight, as will you, as will I. We will see you folks tomorrow with, I believe, is EY from SoFi coming?
EY from SoFi in the house, in studio with you. It's going to be hot. I'm going up to see my mom in the Great White North. That would be Syracuse, New York. It was her birthday. Yeah. So thanks for that.
I texted her. See you later, everybody. We'll catch you tomorrow.
See you guys. Bye.